Hello everyone, welcome back to Fundrise Finance. With the stock market hitting a new low every other day, the investor confidence surely would have taken a beating this year. But as a dividend investor, such markets provide an amazing opportunity to add stocks which are at a very good valuations. And if those stocks provide amazing dividend increases, it's a double gain. In today's video, we'll discuss few such companies who are not only great in their own areas but have also recently announced amazing dividend increases. If you like such content, please do support my channel by hitting that like and subscribe buttons and hitting the bell icon so that you're informed of any such video that I post. So without any further delay, let's check them out. The first company on our list is Caterpillar Inc., ticker symbol CAT. Caterpillar manufactures and sells construction and mining equipment and industrial gas turbines worldwide. It is from the industrial sector and is often considered a leading indicator towards the infrastructure sector. Caterpillar has a market cap of $102.75 billion, which makes it a large cap stock, and currently yields 2.49% at a current PE of 15.49. Year to date, Caterpillar has fallen almost 7%, which is much better than the broader market, which has fallen more than 20%. In the last year, it has fallen just over 8%. In the last 5 years, it has returned almost 80%. From the dividends point of view, Seeking Alpha shows Caterpillar raising its dividends just for the last 1 year, which I don't think is correct because if you look at the dividend history, we can see dividends being raised every year. The 5 year dividend growth rate is 7.59%, which is almost on par with the current inflation. The payout ratio is good at 41%. Caterpillar recently announced a dividend raise of 8%, which is on par with its 5 year growth rate. Tracking Dividends gives Caterpillar a dividend score of 95 and considers it undervalued by 28.8% with a fair value estimate of $270.58. But as per my dividend calculations, which considers recent and past dividends, I calculated Caterpillar to be undervalued by just 1% with a fair value of $195. So if there's any correction in the Caterpillar stock price, we can see the price getting much better valued. So at the moment, with the price being close to fair price, I would rather wait for the stock price to get corrected and then consider buying into it. The next stock on our list is Oracle Corporation, ticker symbol ORCL. Oracle is from the information technology sector and provides products and services that address enterprise information technology environments worldwide. Oracle is a large cap stock with a market cap of $180.69 billion market cap. It currently yields 1.89% with a PE of 12.89. Year to date, Oracle has fallen almost 23%. In the last 1 year, Oracle has fallen almost 13%. In the last 5 years, it has returned almost 48%. Recently, Oracle had announced its quarterly results, which were better than expected, which saw the stock price raising almost 13% on the announcement. From a dividend standpoint, Oracle has been raising its dividends for the last 9 years with a 5 year growth rate of almost 15%, which is really good. It's much better than the current inflation. The payout ratio is very good, just over 26%. And also, along with the recent results, Oracle had announced its dividend raise for 19%, which is really amazing. It's much better than the 5 year growth rate. Tracker Dividends gives Oracle a dividend score of 75 and considers it undervalued by 5.85% with a value estimate of $71.93. But as per my calculations, I found Oracle to be undervalued by 17% with a fair price of $80. The third stock on our list is Target Corporation, ticker symbol TGT. Target is from the consumer discretionary sector and operates as a general merchandise retailer in the United States. If you ask me, Target should be considered under the consumer staple sector, just like Walmart or Costco. But yeah, it is what it is. Target is a large cap stock with a market cap of $64.59 billion and currently yielding 3.1% with a PE of 16.19. Year to date, Target has fallen almost 40%, with the majority of it, almost 25%, falling on just one day, that was May 18th. That was when Target had announced its quarterly results, and it said that its profits would take a big hit due to inventory and high costs. From a dividend standpoint, Target has been raising its dividends for the last 54 years. That not only makes it a dividend aristocrat, but also a dividend king. The 5 year dividend growth rate is 8.45%, which is on par with the current inflation, with the payout ratio is good, just over 28%. In spite of the stock price taking a big hit in recent times, Target boosted its dividend by 20%. It's really amazing. Track Dividends gives Target a dividend score of 96 and considers it undervalued by 47.38% with a fair value estimate of $264.74. But as for my dividend calculations, I found Target to be undervalued by 30% with a fair value of $181. The Target is not a small time player. It has been in the industry for far too long, and I'm sure it will correct itself. But with such massive dips in the stock price, the valuation has become very, very good and gives a great buying opportunity. I found it an amazing buy and even considered it as part of my dividend stock picks for mid-June. So for those who may not be aware, I do post a series of dividend stock picks at the start and middle of the month, where I consider 5 stock picks which are extremely good value at that point of time. So please do check them out. And the last stock on our list is FedEx Corporation, ticker symbol FDX. FedEx is from the industrial sector and provides transportation, e-commerce, and business services in the United States and internationally. FedEx is a large cap stock with a market cap of $59.59 billion and currently yielding 2% with a forward PE of 11.13. With a forward PE of 11.13. Year to date, FedEx has fallen just over 11%. The last 1 year, it has fallen just over 20%. From a dividend standpoint, FedEx has raised its dividend just for the last 1 year. Here we can see the historical payouts. It was paying 65 cents for 2019, and with the COVID pandemic hitting in 2020, FedEx had not raised its dividends in that year, and that has broken its streak of dividends. It started raising back in 2021, and just last week, it announced a monster dividend raise of 53% that brought its payout to $1.15. So it's more than made up for what it did not raise in 2020. And what that recent monster raise has done is raise its 5 year dividend growth rate to almost 13.5%. The payout ratio is amazing, just below 16%. Tracker dividends gives FedEx a dividend score of 60 and considers it undervalued by 51.57% with a fair value estimate of $474.66. But as for my dividend calculations, I found FedEx to be undervalued by 34% with a fair price of $307. So these are the 4 companies which we just discussed: Caterpillar, Oracle, Target, and FedEx. And with their dividends being increased, which are on par with the current inflation, offer a great way of raising passive income on the side. And when the stock market recovers from its recent downturn, we can see the price appreciating in all of these stocks, and that should provide some good results. That's all I have for you in this video. Until we meet in the next one, let's do as much as possible to be financially healthy. See you. Bye.